Okay, in the last video, this is the third one I'm working on, I want to spend some time talking about GAAP, Generally Accepted Accounting Principles. Go back to yellow for a second. It turns out that it's the Security and Exchange Commission, the SEC, which is the Security and Exchange Commission. The SEC is kind of the broad, overarching agency that is responsible for the establishment of generally accepted accounting principles. Now, the SEC has designated authority to what's called the Financial Accounting Standards Board. So the FASB is what this refers to. The SEC has designated authority for the establishment of generally accepted accounting principles to FASB, the Financial Accounting Standards Board. And the Financial Accounting Standards Board is it's a private sector group that determines GAAP. So let me come down to GAAP. Here's where GAAP falls, Generally Accepted Accounting Principles. So we're going to be spending our time down here. But I don't want to put this in the context of seeing that there's a bigger picture. The SEC designating authority to the Financial Accounting Standards Board. And this is a U.S.-based, United States-based agency. Internationally, instead of FASB, they have the IASB, which is the International Accounting Standards Board. We're going to be spending most of our time here with FASB. But both of these are kind of regulatory agencies that oversee generally accepted accounting principles. There's merging going on here so that as we become more and more global, how accounting information is reported will be more universal globally. But for now, let's just talk about FASB and the Financial Accounting Standards Board establishing generally accepted accounting principles. And under GAAP, we have four primary areas. The first is called the measurement principle. And it deals with how do we measure things when it comes to accounting. Let me just call it the measurement principle. The measurement principle says that when we're recording accounting transactions, we record them at cost. As we're buying things, we record things at cost. It's also referred to as the cost principle. Another generally accepted accounting principle is called the revenue recognition. And this deals with the question of when do we recognize revenue from sales? When do we do it? And we're going to find out that the revenue recognition principle is that when companies to recognize the revenue when they actually sell the product. So that's when revenue is recognized. It's recognized when it's earned. Along with the revenue recognition goes the expense recognition principle. And the expense recognition principle deals with the question of, it's really called the matching principle. And the matching principle is that we want to match the expenses with the revenue. We don't want to have a situation where in one accounting period, let's just say this is period 1 and this is period 2, we don't want to have a situation where we are recording the revenue in time period 1, but the expense in time period 2. We do not want to have that. The matching principle says we want to be recording the revenue. Let me get a different color pen. Matching principle says we want to be recording the revenue and the expense in the same time period. So that's the expense recognition revenue. And the last principle here under GAAP is, let me go back to my blue pen, see if I can squeeze this in here. Number 4, it's what's referred to as the full disclosure principle. The full disclosure. And my handwriting is horrible. I'm glad you can at least hear my voice. Full disclosure principle. Full disclosure principle deals with this. That when we're recording and when we're reporting our information, it basically says that it's necessary for the company to report the details behind the financial statements that would impact the user's decisions. Usually what this means is you're going to have lots of footnotes which accompany the financial statements. And if you look at the financial statements for a typical company, especially a publicly held company, not only will you see numbers, not only will you see financial statements like an income statement, a balance sheet, statement of cash flows, not only will you see that, but what you're going to see is lots of footnotes that accompany those statements. The reason for the footnotes is because of the full disclosure principle. It's necessary that the company reports the details behind financial statements that would impact the end user's decisions. So that's why you will often see footnotes which accompany the financial statements. So I just wanted to introduce this idea of GAAP, again, generally accepted accounting principles. In the last video I talked about these are the rules of the land. If it was a baseball game, there's 9 innings in a baseball game, innings. But also, in INGS. But also there's 3 strikes, right? 3 strikes and you're out. There's 4 balls. 4 balls and then you get a walk and you walk to a base, right? Where do these rules come from? Those are the rules of baseball. Those are generally accepted baseball principles. Those are GAAP, generally accepted baseball principles. Well, when it comes to accounting and financial reporting, we have GAAP, generally accepted accounting principles. They're the rules of the land. The rules of the land when it comes to financial reporting. So that's it for GAAP. We're going to be spending a lot of time learning GAAP, applying GAAP, applying the rules of GAAP as we record transactions. But that's it for this video. See you in the next one. Bye-bye.